Oh, I cannot hear you. Let's see. I cannot hear anything. Shoot. Can you unmute yourself? There we go.
Okay, gotcha.
Perfect. Can you see the agenda on my screen?
I can see the agenda.
Okay, good. That's what I was
Hi,
hoping.
Sharon. Can't hear you, Sharon.
I can't see Sharon's
I
on.
can see Sharon and Tom. Okay, there you go. Hi, Sharon and Tom.
Hi.
There we go. Hi, Sharon.
Hi, Mary Beth.
How are you?
Pretty good. A little tired of being stuck in the house.
I know. I hear you.
Okay, yeah, the agenda is there. I guess we should leave that. You're going to put things up there?
This is my first try at it, so I'm glad that you can see it. And then I will click as we go along and we'll see what happens.
Oh, good. Okay.
Hopefully it'll pop up.
Okay, so you'll put the presentation up there too?
I will, yes. Anything that's in blue, I think that I can click on and it should pop up. Fingers crossed.
Okay.
Okay.
And here's Bill. Hey, Bill. Oh, he's muted also. You have to unmute, Bill.
For some reason with this, here we go. Let me see if this works.
I was purposely unmuted. I didn't think you want to hear from me, though. All right, I'm going to mute because just say there's no feedback.
Morning, Marcia.
Good morning, Mary Beth, and everybody.
You look so bright and awake.
I decided I had to do something. I can't stand being on these calls and being so washed out.
You're all dressed up, Marcia. You got all dressed up for the meeting.
I put pink on. That's what I did. You put red on, John.
That's just the old sweatshirt.
Yeah. Hi, Sharon.
Hi, Marcia. Haven't seen you out walking lately.
I've been doing it.
Okay.
How come Nancy's picture isn't up there?
Her name was up before.
I don't know if she's on.
Her box showed up before, but now it's gone.
I see her box now.
Oh, wait a minute. I can go over here. Oh, yeah, there she is. Okay, Nancy. Morning, Chris.
Good morning, everybody.
Morning, Chris.
How are you?
Good. How are you?
Good.
Somebody's calling in.
Morning, everybody. This is Skip.
Don. Well then. It's a ringing noise. Calling in.
Morning, this is Dan here online.
Oops. Okay.
Danny, you're just going to be on the phone?
Yes, I am. Why are people there?
Yeah, we're here. No, we don't see your face, so it just says call. And
Yeah, I'm just going to be on the phone, John. Yeah.
okay. Anyone here from Skip? Did Skip say he was going to be on?
I'm on now. Can you hear me?
Oh, you there, Skip?
Yes. Good morning. I'm only on the phone as well.
Okay. Okay, so we are all here. So I'll call this meeting to order. Why don't we jump right into Chris's presentation?
I think I have the ability here to share, right?
Actually, I think I can do it, Chris. I just clicked on, so let's see what comes up.
Okay.
Yeah, the PDF is, let's see, looks like it's slowly loading. Yeah, it's slowly loading.
Okay, I see it.
Ah, there it is.
Hey, John, we want to go ahead and approve the minutes from last.
Okay, let's look at the minutes from April. Do I hear a motion?
It's Sharon.
Okay, you got that, Mary Beth?
I did, yep, thank you.
Okay, any other comments or questions on the minutes?
Yeah, I noted there were just a few small typos, John.
Okay. Why don't you send those to Mary Beth? Nothing significant?
No.
Okay. All right. And anything else?
I'll send those to you. I'll email those to Mary Beth.
Okay, thank you. Okay, anything else? If not, all in favor?
Aye.
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 Opposed? Okay, motion carries. Thank you.
Just tell me who seconded those.
Who was the second on that? Hearing none, I'll be the second then.
Thank you.
Hang on a second.
Okay, then we're ready to go. Okay, Chris.
All right, so I'm just trying to see if I can control the slides at all. Do you have the ability to share it with me?
You know what? It's still slowly loading. I'm wondering if it would
Oh, that's
be
right.
faster if
It looks like, yeah, it looks like you're trying to load it from the net. Let me
You want to give it a try?
Do you mind? Because I have the
No.
PDF, I have the PDF right here, but it looks like you're trying to go on sort of on a website and download, and that could be it.
You know, it is. I'm taking it from iCompass. So yeah, you go ahead.
All right, let's see here. You guys have it? Can you see the report?
I can see it.
Everybody else see the report?
I cannot,
I've
but
got it.
that's,
Me.
Okay,
Yeah, I'm watching it on my computer here, so I'm okay.
so you can see me moving it. All right. So why don't I begin? This is the DC diagnostic, where we took a look at the 401A plan with Voya. And I think, as you'll see in a moment, if you had an opportunity to peruse the report ahead of the meeting, I think you'll see that the plan is in pretty good shape. I think it's in really good shape from, kind of a menu design perspective, kind of the funds that you offer in the lineup, and then just the overall kind of fees are pretty reasonable, given that it's a relatively small plan. Sometimes those initial fees, you just got this fixed income fee that you're trying to allocate, across, participant base. And sometimes those fees can be pretty big. So, you look at a startup plan and a record keeper vendor may come back and say, hey, look, our fixed cost, regardless of the size of the plan, is $20,000. So, you're going to have to try to allocate that cost in some fashion. As we look at the fees here, are pretty reasonable. We offer up some solutions to maybe how you might want to consider paying for those record keeping fees. Right now, it's pretty common practice that the participants pay for it. But, given that it's a small population, given that the dollar amounts are not big, you do have some flexibility there, and we'll kind of walk you through that. Somebody's got some feedback. I don't know if they're on mute or not, but so we took a look at really kind of the goals and objectives, is to kind of look at investment menu design. We looked at sort of the fee analysis. We included sort of a governance document around the policy statement as well. We think that's an important document to have in place, just like you do for your pension portfolio as well. So we have a draft IPS, and then the charter is included that you've been working on as well. So let's just take a high-level executive summary of the plan today. Currently, there are 21 investment options. We'll take a closer look at that, and that's pretty reasonable, right? There's some plans that come over to FIA and they have 75 or 100 options in the plan because the vendor just keeps adding options as they're made available, and that can be really overwhelming to participants. So you can imagine joining the plan or being in the plan and looking at all these investment options and be like, boy, where do I put my money? We kind of call that challenge choice overload, and you don't have that problem here with Ledyard. So the changes that we're proposing is really kind of around the margin, streamline a little bit, maybe remove some of those funds that are what we like to say first generation funds, like a balance fund where now you have a target date fund. So we'll look at that in a moment. I think the optics around the menu design are a little bit easier to follow. But as you can see here, just some minor tweaks that we'll take a look at. The fees today, so 91 basis points are kind of the total fee structure. We'll look at that more closely. And then Voya receives of that 91 about 53 basis points. So that's their kind of required revenue that they need to run the plan. And when you monetize that, I think it runs about $8,000 a year. So the current pricing structure, the participants, kind of that weighted fee is about 91 basis points. So that includes, as you'll see in a moment, the expense ratios of the investment options plus what we call kind of the wrap fee or the record keeping fee. One alternative pricing structure that we'll look at is if you want, as an organization, to say, hey, look, as kind of an added benefit, maybe the town is willing to absorb this record keeping fee so that the participants are just paying for the fund expense ratios, and that provides them a higher net return in their portfolio, kind of a goodwill gesture. You will always have the flexibility to go back and say, okay, well, at this point in time, because of budgeting issues, even though the annual fee that you might be covering is around $8,000, you might come back and say, we just want to go back and have the participants pay for it, and you could always do that. But we'll show you the flexibility around that. We've had some plans that have come back, particularly the startup plans like yours. I say startup, under $1 million or so, that have said, hey, we just want to just alleviate some of these costs to the participants. This is their primary retirement vehicle, and we'll absorb that, and we think it's a good message down to the participants. So, kind of some key tenets around, menu design. One is upper left-hand corner. For us, it's really simplification, and we've seen this over time. There's a number of really good behavioral finance studies that suggest that, streamlining the menu, achieves a couple objectives. You improve participant outcomes, you avoid choice overload, and that's really kind of the core objective. And just given, you'll see in a moment, the popularity of target date funds, 82% of the plan assets are in the target date funds. They're a really great strategy, kind of this autopilot feature that participants have gravitated towards. That also serves as an impetus. So do we need these other investment options because these solutions have become popular? We offer some active and passive strategies, right? So for those participants that want to go for some active funds or passive, also known as index funds, low cost index funds, you offer that solution as well. So some really kind of the key tenets that we kind of advocate are already in place for your plan. So here's your current investment menu, right? So we call it an investment menu because participants have a choice. So when I enroll in the plan, or I'm currently in the plan, I have all these investment choices to select from. And if I move from left to right, it's my kind of more conservative fixed income options. We have the stable value fund where it just, behaves like a money market account, only provides a higher net crediting rate than a money market account. The fixed income options that you offer today, you'll see you offer the Pioneer Bond Fund, which is a nice core bond fund. We offer kind of this TIP strategy and this Eat Advanced Income Fund. This is a high yield bond fund. And, we've highlighted the ones in red where we're suggesting we kind of eliminate from the plan. One is, we tend not to advocate having a high yield bond fund in a DC lineup. I think it's a little bit of a misnomer. When you look at high yield, participants think, well, I can get a higher yield. Why don't I go into that fund? But they don't understand the credit risk. And in the first quarter, high yield bonds really took it on the chin, given sort of the dislocation in the credit market. So this Pioneer Fund, you get a little bit of exposure in high yield, but the strategy is kind of a nice core bond fund, which we think would be just a nice strategy to offer. And we'll see the final lineup in a moment. So here's your balanced fund. So this is the suite of the Vanguard Retirement Index funds, our target date funds. And what's attractive about these funds is they start off, with a relatively high equity allocation, and over time they get gradually more and more conservative. So it's sort of an autopilot feature for participants where they can invest in these strategies, and as they get closer to retirement, the asset allocation gets more and more conservative, and they become very popular DC plans over the last decade. For those reasons I've described. And then you've got these other kind of old school balance funds that have, a static allocation between stocks and bonds, which by themselves are nice strategies. They're good. We don't have any concerns with them. But when you've got this new generation of target date funds, we think participants are better served if you can just offer up these strategies and kind of remove these options. We've got very little utilization, as we'll see in a moment. But, we've worked with our clients to say, okay, if these are kind of really the new generation of choice, we could move away from these funds, because at some point in a participant's career, they're going to have to make a decision. Am I no longer that 60-40 investor and I've got to get more conservative? So I'm going to have to do something. This suite of target date funds really kind of removes that decision process from the participant, in that it automatically gets more conservative over time. You offer domestic equity only funds. So these are your domestic equity funds across capitalizations, large cap, big cap, and small cap. And then you'll see you offer an index strategy in the large cap, index strategy in the mid cap, and an index strategy in the blend. So you are offering the participants options, to go down the path of, boy, can I get an index fund at a couple basis points, or do I believe in active management? But it's just the choice that you offer, and that's fine. We think that's a really good approach. Other plans that we inherit, they'll have, 7 large cap value funds in this space. And what will happen is participants will just gravitate towards the better performing fund Hi, is everybody still there? Everybody's, I just want to make sure. I came across the screen, I saw everybody's face was gone and there were some X's. Looked like we lost connection. So I just want to make sure it wasn't, my internet connection.
Lost you for about 30 seconds, Chris.
Yeah.
So kind of on that menu design structure, you could see we offer sort of some choice between, active and passive investment strategies. And as I may have mentioned before, we got a little bit disconnected. There's some plans that we inherit will offer, 5 or 6 large cap value funds. And that's really confusing because then, participants will just look in that space and say, well, what's the best performing fund? I'm just going to put my money in that, not understanding sort of the kind of the risk profile. But here you've got sort of, one option within each of these categories, which is something that we would certainly advocate. In the international markets, again, we think, you've got an index offering here. We would probably complement it with another international fund. And then I think in a specialty area, the REIT strategy, we probably remove that option, just given that participants really truly don't understand sort of the, how kind of REITs work. So kind of our suggested menu, as you'll see here, one is kind of keep the Pioneer Fund. And then, similarly, what we've done in the domestic and international space is offer an index fund. So you offer participants choice. You can offer them sort of now the Vanguard Bond Index Fund at a couple of basis points. So you offer active versus passive. I think the attractiveness of this Pioneer Fund, it's a really good core plus manager. We would suggest keeping sort of the Vanguard suite. You can see we would replace 2 of the funds that are currently in the lineup, kind of either from performance concerns or just some other qualitative concerns that we have. So we had a flexibility to kind of make some changes, MFS mid-cap value and T-Row. And then lastly, in the international space, keep the index strategy and then complement it with, America Fund, Euro Pacific Growth Fund. You already have some America funds in the lineup. It's a name I think that resonates well with the participants. And this is just a really solid international fund that invests in both developed and emerging markets. So we think it just really kind of complements sort of that active versus passive solution. So before I jump off that, so here's where you can see where participants have allocated the money. So you can see there's not much really across a lot of the choices, really less than 1%, where all the utilization is right here within the target date funds. We've got 82% of the plan assets residing in the target date funds. And to put this in perspective, the plans that I work with, you'll see that target date funds generate anywhere between 35 and 82%. You're kind of on the high range, but that's fine of interest. So they are very popular. This number to me, I take some comfort in there because I think the participants are well served by utilizing these strategies. They get diversification, professionally managed. But when you're looking to make some of the changes that we're proposing in the lineup, you'll see that, there's very little utilization in some of the other strategies. So on page 10, as we've illustrated, this would be really kind of the lineup that we would suggest we move forward to. And if the committee's inclined to buy into this lineup, what we would do is work with Voya and you to communicate that change. It probably would take about 90 days. You have to communicate back down to the participants. Unlike the pension portfolio, we can make a change overnight, right? There is communication that is required at the participant level in a DC plan. So it pretty much takes, about 90 days start to finish. Voya would have to get the funds on, in place. Communication would go out. Participants would have about 30 days to move their money. And if they didn't move their money, they would be mapped into kind of sort of like funds, right? So we'll create all that kind of analysis for you to share with Voya. But any thoughts before I move into pricing? Again, we have in the back of the report our due diligence on and performance on all these funds. I think all these funds in the lineup, if you had a chance to take a look at it, delivered really solid results. And again, I can't emphasize, how good of a shape that the lineup was in to begin with, and the funds that you offer, really solid options, Vanguard, America funds, DFA, names that really, I think, resonate with, potentially resonate with your participants. And then you offer, again, active and passive solutions. But a majority of the interest continues to reside in these Vanguard target date funds, which have done a very good job. Active managers had a really hard time, outperforming in that space. So a nice low cost solution for your participants.
Okay, questions for Chris right now? Anyone?
I guess this is Bill. I guess the question I would have, and this maybe isn't necessary for Chris. So we can, if we change the fund structure, we can mandate that. I mean, I remember the 403B, all those legacy kind of hung on there because anybody that was in the legacy was able to stay in those plans. We can do that. We can say, here's restructure, and force them to go over.
That's correct. In the 401A plan, you can. The 403B plan, to your point, might have had some legacy, kind of those individual annuity contracts, which can be problematic. Within this plan, it's 401A plan, and the changes are pretty seamless. Yep.
Chris, as part of this, besides simplification, is there any fee impact with this? I mean, less plans doesn't mean less fees because each plan has its own fee.
Yeah. So it's a good question. So what we'll do here is we'll jump to sort of the fee analysis. So I talked about performance is solid. So let's look at the full fee disclosure. I think it's easier to look at the optics on this page. It's pretty easy to follow along. So if you look at this on the left-hand side of this column are all the funds that are currently offered in the plan. You'll see as of 12/31 how participants have allocated their accounts or their assets accordingly across all the strategies, right? So from top to bottom, you can see where the assets were allocated. At the end of the day, total plan assets, at the end of 12/31 were just shy of $800,000, and you had 92 participants in the plan. And then if you look at net fund expense, these are the expense ratios of each of the funds in the lineup. Now you get institutional pricing, right? These aren't retail, these are institutional pricing. It's a qualified plan. So you're not subject to any upfront loads or anything like that. But as you kind of descend down the page here, you can see kind of the expense ratios, and that's, netted out of investment performance, but still it's an expense ratio that the participants bear. Very similar on the pension side. We have, kind of a number of 40 Act funds that have an expense ratio associated with that. And what you'll see
Excuse me, John.
Yeah, who's that? Go ahead. Yeah.
This is Dan. Can you hear me?
Yep, we can.
Oh, I had to dial back in. I think I cut myself off. Hey, Chris, I'm sorry to back up a little bit. I just had one question on the proposed menu. On the blue chip, the U.S. growth blue chip, was any consideration given to a Vanguard fund instead of the T. Rowe Price?
In the large cap growth space, I think our preference was for T. Rowe Price large cap growth. I offhand I don't know if Vanguard has a large cap growth that's sub-advised, but I think
and that part I'm not sure on if they have an institutional one, but I know on for investor funds they have one a blue chip growth, and just looking at it, it looks like it outperformed its index, the Russell 1000 Growth Index, for all the 1, 3, 5, and 10-year periods, and it has an expense ratio about half that at T. Rowe Price. Okay. Again, I'm not sure if they have an institutional fund. I know the investor one is VWUSX.
So why don't I take a look at that and we'll run it along T. Rowe and come back to you. It's a great question. It's a great question. So again, we have the flexibility. We'll ensure that it is offered on the Voya platform, which I suspect it is because of the Vanguard suite that's in there. And again, if we've got some pretty good numbers and it's half the cost, then we'd certainly probably advocate that. We're not married.
Like I said, I didn't know if they had an institutional one or not, but I just thought I'd throw that out.
Yep. Yeah, I'll have that as a takeaway. That's good. Thanks for the observation.
Thank you.
Hey, Chris, going back, what page were you on when you were talking about the fees? Where were you?
Yep, I'm on page 25.
Oh, okay. All right.
Okay. And I'm hoping those that are on if you're able to follow on the screen, I have it up on the screen as well, but you let me know where If you're looking for a page number, please let me know. I'm on page 25.
Okay.
And so as we kind of move left to right here, so each of the funds in the lineup, how the assets were allocated. You'll see the expense ratios for the funds. So again, if you look down the page, you'll see, Vanguard, we're at 4 basis points for the total stock market index fund. And then you'll see sort of that 80 basis point wrap fee. So that's the record keeping fee that Voya applies. It's an annual fee, and that's what the participants are subject to. So when you add the expense ratio and you add the record keeping fee, and it's very common in DC plans because participants typically bear the record keeping fee, you get this total net fund expense ratio column accordingly. So if I look at the Pioneer Fund, right, the expense ratio is 35 basis points. There's an 80 basis point record keeping fee. So participants bear really this total cost of 115 basis points. And if you look at where kind of the yield is on the 10-year at 70 basis points, that's a pretty big obstacle to overcome, right? But in any event, so this is kind of that total cost. As you descend down the page here, you can kind of see, the index strategies, the target date strategies are very popular. One thing that's very popular with Vanguard is the cost structure, 13 basis points. Some of the active target date funds from Fidelity and T. Rowe can be anywhere between 45 and 75 basis points. We're running these between 12 and 15. So even with an 80 basis point wrap fee, you're still under 1%. But when you kind of do this weighted kind of expense of the portfolio or the lineup, you're at 91 basis points. Of that 91, right, because there's a wrap fee, 78 or 80 basis points we could just round up, goes back to Voya. And when you monetize that, that's about $6,000. There's also a 25 basis point fee that Voya applies to the plan sponsor. That's about $1,900 a year. So Voya nets out about $4,000. They do, of this money that they receive, 50 basis points goes back to an advisor that assists the town of Ledyard with participant education and on-site meetings. So Voya doesn't keep all that revenue for record keeping. It kind of goes to the advisor. So one thing.
Hey Chris, I'm sorry. This is Dan. Are those fees that you see with Voya for the recording fees and paying back to advisors, is that your perspective? Is that typical of what you generally see from other providers? I mean, is it reasonable or?
Yeah, I think it's reasonable because, as I mentioned to start off with, just given the size of the plan, I was expecting these numbers to be, maybe 125 basis points or so, of a wrap fee. So, I think 80 basis points, the dollar amount that we're dealing with here is just so small. So I was pleasantly surprised that there just wasn't a hurdle fee, look, our flat fee is $25,000. Our minimum fee is $25,000 because we just have a cost to run your plan, regardless if there's, So yeah, I do think they are reasonable. Now, if you can, so when we make the changes to the lineup, you'll see that there doesn't really impact, with the new funds, the overall cost, because just such a majority, 80% of the assets reside in the target date funds. One thing that you can consider, we kind of did this kind of alternative fee structure, is you can remove that wrap fee at the participant level, right? So the participant would just be bearing the expenses of the funds. So that 80 basis points would go away. Kind of that weighted expense ratio now drops down to about 15 basis points, again, because the majority is in the target date fund. So you eliminated this record keeping fee at the participant level. And then what would happen is that the town plan sponsor, would kind of pay this $8,000 or this 1% annual fee billed quarterly. So you remove this kind of hurdle record keeping fee from the participant side. Now, if this fee was $35,000, $50,000, you'd probably come back and be like, look, that's a budgeting issue, right? But I think for purposes of discussion, because it's under $10,000 today, we wanted to bring that to your attention to say, hey, look, is this something that you think you might want to absorb? Would it be part of an overall benefit package enhancement that you have the ability to go out and say the town absorbs all the administrative and record keeping, participant education fees? You just pay for the expense ratios of the funds. And we confirm with Voya. So you do have that flexibility to say, okay, we don't want the participants, bearing this 80 basis point, annual record keeping fee, given that it's, under $10,000. I think the town will, for the foreseeable future, kind of maybe cover that cost. So that is one thing that you have flexibility around in terms of covering the record keeping costs. We do think that these record keeping fees are very reasonable and commensurate with the services that are being delivered. Again, I was pleasantly surprised that we didn't have a minimum fee of $20,000 or $25,000, where now you'd be looking at 125 BIP charge or so.
Hey, Chris, Dan again, just curious on that note, do you observe, or have you seen where other towns would cover that record keeping fee as the sponsor? I mean, again, is that something that's typically done in your experience, or more of an exception?
Well, I would say I'd answer that in two ways. One is I think there's a number of towns out there, from just our perspective, because of the ones that we've inherited, that have no idea what the costs on the DC side. And I say that respectively because I think what has happened is, the pension plan and the OPEB plans are typically under the purview of a committee, but the DC plan tends to reside in in HR or under the purview of the finance director, and that's a challenge with respect to having that individual have that significant responsibility. So when we do get retained on the DC side, we kind of go through this exercise, and it kind of dawns on the individuals at the table. It's like, I get it. Okay, so now I know what the fees are. I would follow up then and say, there's an appetite for under $15,000 to cover the fees. I think when you get north of that, you start dealing with a budgeting issue where, $35,000, $40,000, there's not an appetite. So I've seen the towns cover the 401A fee and then not cover the 457 fee because of, it might be much larger. So town of Southbury, for example, covers a portion of the fee. Bloomfield, that I work with, covers the 401A fee. And again, you have that flexibility. You could do it for a year or two and then, change your mind.
Okay, thank you.
I just want to be sensitive of the budget, that $8,000. Obviously we just went through a very difficult first quarter. I'm sure all budgets are going to look at line by line. So, but you have that flexibility.
This is Bill Thorne. I guess this might be a question for Don. So this is the 401k or the 401a, and Voya provides advisors and education to the participants, on-site meetings. What do we have? I mean, for the 401a, when do they do that? We've never heard about them coming and talking to participants and all.
Yeah, I'm mute. Don.
Can you hear me now? Sorry, I had it muted. So the Voya and Prudential representatives come here, or had in the past, about every 6 weeks, specifically to meet with any new employees or any other employees who are in the plans already who wanted to sit with them. So they are here for that. They've also offered, group sessions, which we don't do anymore now. But they are here frequently and they spend time, at least a half an hour, with each new employee on both sides, the Prudential and the Voya. So they get the account set up, they get the portfolio prepped, and we start having people contribute immediately when they're hired.
But I guess the question I have, Don, is that I know they come for the DC plan and talk to participants, but this is different, right? And these participants are different than that. Would they actually come to talk about the 401a plan with the participants?
Yes, they do.
Okay, all right.
I forgot the woman's name.
Maureen Weir.
There you go. Thank you.
Hey, John, Rodolico, Dan again, just I guess for everybody to consider. So I could certainly see that, the advantages, the selling point, if you will, to the employees if the town covered that. And as Chris points out, it's not a huge number, but I guess my other thought on that too, though, is it's one of those, you know, once you let the genie out of the bottle, I don't know what these total plan assets, what they might grow to in the future, or if in the future Voya determines to increase that record keeping fee at all. But again, it's one of those, I would think if we agreed to cover that, if the town agreed to cover that for the employees, again, the genie's kind of out of the bottle, and if down the road that starts to get to be tough from a budgeting point of view, it might be hard to go back.
Yeah, Dan, what I'd like to do, if the board's amenable, is Chris is making recommendations to us. You know, I don't know if we're prepared today to get the clock started on the fund realignment. I think that's kind of an easier one, unless the board wants to wait on that. I think the issue of who pays for the fees, I'd like to put that on the agenda for the next meeting so we all have a chance to think about that a little bit. I have a couple of thoughts on that. For instance, Don, real quick, this particular plan is a vesting requirement. So the point is that an employee needs to remain for, what is it, 4 years?
5. It's 5 years.
5 years. We have employees, no doubt, who leave before the 5 years. I don't know if we've had any so far. We certainly have, right, Don?
Yes.
And when they do that, that money comes back to the town, correct?
That's correct. So they vested 20% a year, fully vested after 5. We have had employees who've left, and we've pulled, you know, when they go to pull their money out, we have to sign off as the administrator, and then we calculate the, you know, they're 40% vested, they get 40% of it, and the rest comes back to the town.
Okay, so
another point, go ahead.
Well, so then the town doesn't really net any money, because if they leave earlier, the payout is less. So there's no money.
It goes into a forfeiture account, and if there's a match in your plan, you can use that money to offset your annual match.
Well, that's what I was wondering about. And this is, you know, as Dan just pointed out, and we certainly want to give consideration to the mayor on this. You know, this could grow. That's a good thing, because it means our employees are taking advantage of the plan. But I think that's something I'd like to have a little bit time to think about and talk about that next month, Dan.
Yeah, no, I agree. That's a good idea.
Can I just throw one more thing in as a, you remember some in the July or August timeframe from last year when we got the notification from Voya that they were increasing the fees, the town continued to pay the 0.25, and the balance of it was put back onto the employees' plan. And that's what sort of when they raised the fees last year is what sort of drove this assessment, the request for FIA to come in and look at this plan.
Okay, now, Don, is there any consideration, Don and Chris, is there any consideration? I know we would like to move this plan to Prudential.
Yeah.
But there's,
Go ahead.
I see Chris shaking his head.
Unfortunately, yeah, we reached out to Prudential, and we can't move it to Prudential. Yeah.
Can't, or they just are not interested?
Both.
Okay. I mean, legally, not a legal issue. It's just a matter that Prudential won't agree.
Correct.
All right. So we have a plan here. From what you're saying, it's a reasonable plan. The fees are reasonable. It's reasonable offering. So besides just the possible savings from combining the plans. Okay. So
I would say even beyond reasonable. I think that the lineup is great. I think those Vanguard target date funds, low cost solution have been kind of a home run when you look at other target date families kind of that have a really big active management component to it that have really struggled. I mean, you're getting this diversified strategy for 13 basis points. I mean, that's big. I mean, you've got a manageable lineup. I mean, it was in really good shape. And, then the fees themselves I think are just reasonable. You look at just the absolute dollar amounts are really small. We didn't have that minimum or that hurdle of, say, $25,000, which you do see, right? It's like, hey, we've got a fixed cost to run your plan, whether there's 20 people or 90 people or 100,000 or 700,000, it's 25,000 a year. And now you got to decide how you allocate that. And those fees can be really big. So oftentimes you'll see, half go to the participants, half get covered by the plan sponsor. But, in this case, they're pretty, in good shape. And you can see the transparency. So there's no really all these, hidden charges that you might, that you might suspect. The doc. I'm sorry. Go ahead.
No, Chris, were you going to keep going, or are you?
I'm just going to say that the last documents that we have are governance related on page 28. So on page 29, we have a draft investment policy statement, and kind of in a similar vein to the pension side, right? Kind of this IPS serves as a guideline for governance or oversight of the 401A plan. And I guess you could tether it to the 457 plan if this governing body has that responsibilities as well. And I think sort of the description and the purpose would dovetail with that as well, but we've just kind of isolated it right now just to the 401A focus, but, kind of roles and responsibilities, the objective, around investment menu and options and performance of those options, selection of investments, et cetera, et cetera. So I'll leave this for your perusal. This is a template that has been vetted by ERISA counsel. I know you're not governed by ERISA, but we tend to abide by the spirit of it. So there has been sort of a professional review of this document from kind of a legal set of eyes. So I think you could take some solace knowing that it's in good order. And then obviously you can see here, you would kind of look at the kind of execute the document. And then we just want to share with you, we don't own this document, but this is kind of your charter that's been sort of in the works, and kind of just keep momentum with respect to sort of that governance, et cetera, et cetera. We just wanted to include it in the package. I'll defer to Don and Marcia with respect to this document and where it resides and where you're at. But again, I think two things you look at is the from a governance perspective is the IPS and the charter.
Do we have a policy statement like this for these? I'm sorry. Go ahead, whoever was talking.
Yeah, this is Bill Thorne. Just a couple things. Again, to help me keep this all straight. The 401A plan don't we refer to that as the deferred contribution plan? I think that's what you told me, John, when you were emailing me about it. We got the defined contribution plan, which we say is the DC plan. That's what's in this draft. So again, it gets down to that nomenclature. This is strictly addressing 401A, which is the title says, and I think we refer to it as the deferred contribution plan, right?
In the ordinance, it does use that term, and it appears to refer to this 401A.
Okay. Another question I would have: where would this policy statement get incorporated into, into something that was chartered by the town? Would it go into? Would it refer to it in the ordinance or something?
No. Well, that's what I was going to ask Don. Don, do we have an investment statement for the town's pension plan?
We do. Yes.
Okay. So then this would be a similar document. Now, a document like this, an ordinance would go through the council and then the town. This, I would think, would just be a pension board document, and we have the ability to do that.
Yeah. And this would be something that gets reviewed on an like we do in the pension plan, and it'll be actually this quarter we review the investment policy at least annually to make sure it's current, make sure there's no changes, et cetera, et cetera. So this is kind of that living and breathing document, it's just something that's, I think, you want to have on record. If there's questions from a participant, because again, this is a participant directed plan. Unlike the pension plan, this is a participant directed plan. You're going to get inquiries from time to time. You may even get an inquiry given the market dislocation when participants open up their statements, right? We've had an 11-year bull market, been hard pressed to have a sell-off that we've experienced. It's during those times where participants start asking questions like, well, I didn't know I could lose money in the Vanguard, target date fund so close to retirement, or I didn't know that there were fees associated with this DC plan. And what's the governance structure like? Who oversees this? now you've got an investment policy statement and a charter to say, hey, there is a governance around it. And that's why, I'm concerned with some, other municipal plans that have just kind of, put the DC plan and kind of in the back burner because it's an environment like we just had where there's a lot of volatility where, I suspect you may get some inquiries. And so I think as you kind of did this diagnostic, I think it's great. You create that fiduciary trail and you're like, hey, yeah, we're cognizant of the DC plan. We did some due diligence. We think it's in good order. We had an independent review. Now we have these documents in place here, and we're in good order. Which again, I think the town is.
I mean, if a plan like this, we want to make people aware that the document exists and possibly send it to them, make it available to them. So that I agree with Chris. It's just another thing that shows the responsibility of the pension board and how we're looking and overseeing the town and the employees' funds. Okay. Anyone else? Any other questions?
Yeah. Hey, Chris, just one question. I thought it interesting when I looked at the proposed, the current versus the proposed fee disclosure. Even with the new changes or the recommended changes to the fund lineups, when I look at the total net fund expense, and granted the daily expense is the predominant number there, but when I look at the total fund expense, even with the new fund lineup, it didn't even change 1 basis point, even given the new expense ratios for the proposed funds.
Yeah, because I think, and I could look at that number, how far we carried out the digits there, but with 82 or 85% in the target date funds, you've just got very little utilization in some of those other funds that we want to move. So, if I look at, say, the, America Fund's capital income builder that we want to move, we have $3,000, right?
Yeah.
That's high yield, $920.
Yeah, that's kind of what I figured. Some of them, the numbers are pretty small, and the 0.8 is more, probably a little bit more of a heavier influencer on that. So I guess the takeaway I had, if I'm interpreting that correctly, is the fund changes aren't so much to necessarily drive down the expense ratio for the individuals, although it is the case in some instances. But the bigger issue is really just making it a little bit the simplicity, a little bit more simpler form.
That's correct, and I think also, consistent with offering a passive approach in the domestic and international space, we're offering one now in the fixed income as well. But you hit on all the right points. The biggest cost savings for participants will be on the record keeping fees.
Right. Okay. Got it. Thank you.
Okay. Any other questions or comments, Chris? Go ahead.
This is Bill again, sorry. So we're going to read through this policy because what I see is there's all this, we didn't have much, as I understand it, the pension board didn't have much responsibility for the 401A plan. I don't know how it was managed before, whether there was a investment, statement or whatever, but this does now shift some responsibility over to us, the retirement board, which we have a new name. And right now, some of the things that it looks like in there is we have FIA doing that for our defined benefit plan, giving us advice and all that kind of stuff. So we're going to be responsible, I guess, going forward if we adopt this investment policy, to really get into the workings of what's offered, basically almost a periodic review like we're doing now, and probably less extensively, so that we can take, we can fulfill our responsibility, I guess.
We've had a long partnership with the town of Ledyard, and again, as you move forward and you get the 401A in place, and now you've got a governance body that you're recognizing, once that's formalized, that you have oversight over the plan. As we have our monthly or quarterly meetings, if you get a report from Fidelity, we can certainly share our observations with you and just say you're in good order. We'll just do that work for you at no charge. So again, we'll help you carry out your responsibilities here. Ultimately, at the end of the day, you got to feel comfortable that these are your responsibilities as stewards of the plan. It's a great observation, Bill. But again, we're here to assist you with carrying out these terms. You have any questions, I think you'll be in good standing. pretty straightforward. We'd be glad to look at the lineup periodically if for example, I don't know, half the portfolio management team gets up and leaves Pioneer, we would help you in making that fund change or say, hey, look, here's why you want to get rid of it. So it's not a big issue. If you were to say, hey, we got 150 funds in the lineup we want you to review for us, that's a different story. But you've got a handful of funds here. It's pretty straightforward. So we'd be glad to do that work for you at no cost or help you there. So.
Okay, last question for Chris. Okay, that was the last question for Chris. Okay, Chris, we appreciate your help.
Thank you, everybody. Thanks for your patience. I think, like I said, I think you look the plan's in really good shape, and I think at our next meeting we'll continue to follow up with you and ask questions along the way, and we'll assist with any communication that needs to go over to VOIA. It's a pretty seamless transition when you make those changes, just so you know, and ultimately the decision on making changes to the record keeping fees is a deeper discussion, I suspect, more broadly with maybe other parties involved, but let us know how we can assist, and appreciate the opportunity to assist you here.
Okay, well, no, I did, because you said that, I just have a question. Should we make these changes, we notify VOIA of that, and VOIA in turn notifies the employee?
That's correct. So what we'll do is, if you came back to us saying, hey, Chris, we think the lineup makes sense, what we'll do is put together communication that you can share with VOIA, and VOIA will come back to you and say, okay, great, we're going to get everything in working order. Here's the timeline for making that change. You gave us notice, I'll just say June 10th. We think we could put these changes into place by, August 30th, and here's how it'll unfold. Then they'll send you back kind of a sample of that communication. The town's going to make the following changes to your lineup. You take a look at it. We'd be glad to review it in terms of its content, but that's how it would work.
Okay. I mean, I've had plans. I do have plans where I get mail all the time from funds just saying, hey, we substituted this fund for this fund. Now that's a substitution, and that's pretty much what we're going to be doing. I mean, there are some where there are no investments at all, so there's no impact. So it's something that they do have the ability to do. We do have the right to do that.
Yeah, and then you as a participant, you have 30 days prior to that change. So they'll send you a communication, John, we're making these changes to your plan. You have 30 days to move your money around, get out of these options. If you don't, we're going to move that money for you into a like fund or the plan's QDIA. So for example, if there's money in the high yield fund, I'm a participant, and because we're not adding a like fund, that money would go to the target date fund because that's the plan's qualified default. That gives you protection as a plan sponsor because you're actually now moving that money. So that's how that would work. For the large cap growth fund, we would go from America Fund's Growth Fund of America to another like growth fund. So it's a fund to fund map. So it's pretty straightforward. If the participants don't take action.
Okay. Again, Chris, thank you very much. We appreciate your time, and stay well, stay safe, and we hope to see you again soon.
Great. Thank you. Have a good day.
Okay. Bye now.
Bye.
Okay. Moving back to our agenda. Can everyone hear me?
Yes.
Okay. All right. First of all, the roll call. We do have everyone here present. We also have the mayor, and we have resident Roger Cotting, who's with us again. Roger is very interested in the pension board, following along, certainly as a taxpayer, and possible interest in joining the board when the council gets along to completing the new ordinance, the revised ordinance. Okay, next order of business is the HR report. Don?
Yeah, just real quickly, because John, you and I were talking about this late last week. The numbers, just so you're aware, we have across the town and the participants in the, the secretaries in the custodian union on the board side, 114 employees that are participating in the 457 plan. That includes the DC people and the DB people. So of the 114 that are in our 457 plan, 44 of them are from the pension. So they're putting away additional money that, you know, is above and beyond, just because we have the option available for them. And then there are 70 people in that plan who are in the defined contribution plan that we contribute to the 401A. And I looked at the portfolio just quickly this morning. Our current 457 portfolio is just over 3.5 million, down 300,000 from last month. So I think the portfolio in the 457 has done well. That's just a quick numbers rundown. That's it.
Okay, questions? So we're down 10%.
In the 457 plan, yeah, that portfolio is down about 10%.
Probably not including yesterday, so probably less than that. Unless
I think so, yeah, because this was effective. I guess I ran the number yesterday, yeah, so they didn't get yesterday's run up.
Okay, that's not bad. All right, any questions for Don? Okay, moving on.
Don, really quick, were you going to mention something about the Board of Ed pension that we had discussed?
Thank you. So we discovered there was an issue going on with the whatever her title is, business manager and human capitalist, Rachel Moser, who was hired, and they were sending money to our 401A on her behalf. There were some couple of issues because she hadn't been here 6 months, and I was trying to figure out why. And then I was getting the checks back because they had not set up her account correctly. So it turns out she has a contract with the board, as does the superintendent, the assistant superintendent. And I've asked multiple times for a copy of it, and that has not been provided. They are required by statute to file all their contracts in the clerk's office, which they have not done. But anyway, apparently they have allowed her to make her own decisions on where she wants her pension or her plan. So she's not participating in the defined contribution plan, which is, my understanding, is the default for anybody who's not in our pension plan and not a teacher. So there's some concerns. We may want to have some discussion at some point on, can people opt out, and has she opted out, or is she going to come back in 5 years and say, wait a minute, you were supposed to, you know, this was the town plan and I should have been in there. So there just are some potential problems, and these sort of tie in with John Rodolico's attempts at getting information about the 403B. It's a closed society over there.
Hey, Mayor, is this one that, and I'm only giving this to you because I wore out my welcome a long time ago in requesting things. Is this something you should either formally or informally tell them, and maybe use it as a pretext for reminding them that their contracts need to be filed with the clerk, which would kind of solve the problem if we had access to those?
Yeah, I can do a letter, an official letter to them today for that reason, because not filing the contracts is not acceptable. So why don't we start with that, with, you know, the contracts for central office staff have to be filed per state statute, and maybe I'll give them a timeline of 7 to 10 days.
Okay. And then Don, from there, we can go to, you know, so you haven't seen the contract yet.
That's correct.
Okay. Because the older contract I had for a previous business manager, is probably different.
Yes.
So,
I would expect.
Okay. So then we can look at that. And then once we get that, then we can go from, okay, wait a minute. I don't know that a person can really create their own rules for a pension. I mean, we have 2 pension plans, one of which she is not eligible for, and therefore the default is the DC plan. And
that's my concern, is if she was even aware when she came here, and should she have opted out? Should there be something somewhere that we have, or excuse me, you as the retirement board, is that's the default plan for the town, but she's opted out of it. We have, you know, made it mandatory on the town side with all the contracts. All the unions and the department heads have to participate in the 457 plan. They don't have that, as far as I can tell, with the 2 unions. And now they've brought in another administrator who obviously has decided to do something completely different. So we need to think about that. as far as the retirement board, is there an option for somebody to opt out? And if they do, we need some kind of track record on that so that they don't come back in a few years and we owe them all kinds of money.
The best case scenario is that it's just ignorance, because after all, she has the position that would normally brief people on what to do. So we depend here on the superintendent telling her where her money needs to go. So there's two issues really, whether she can opt out. And secondly, if a person's not in the DC plan, then they really can't be contributing to the deferred contribution plan, or the town should not be doing that.
That's correct. And we have gotten back all the matches that they had sent.
Yeah, right. And you're just holding those.
Well, I'm redepositing them back into my line.
Oh, okay, going back to the town. Okay.
Yep.
Okay. All right. Any other questions for Don? Not okay. Moving along to Mary Beth, if you would just put that as a agenda item on the old business for the next meeting, just as a follow up.
Yes, I
Because
got
I'm sure by then the mayor will have an answer. Okay.
Be new business?
Yeah, it would be new business, right? Okay, Marcia.
I have nothing to report other than the this year's contribution to the DB plan has been made, and we have next year's required contribution in the budget. So everything is all set from a financial point of view.
And what was the difference? Was there an increase or level? What was the?
Well, if you'll remember this, when we got the valuation, we already had money budgeted in this year's budget, and the valuation came after. And it was actually showing almost, I think it was 250,000 less for the required contribution. Excuse me. And so next year's contribution is more than this year's, but still less than we had budgeted for this year. If that makes sense.
No, it doesn't.
Okay, so we had budgeted a certain amount for this year. Then the valuation came out, and the required contribution, according to the valuation, was 250,000 less than we budgeted.
Okay.
We saved a lot of money there. And then next year's required contribution is, I think, 40,000 more than this year's required contribution.
Okay. And that's what's in the budget.
Yes.
40,000 more. Okay. Okay. Very good. Any questions for Marcia? None? Hearing none. Okay. Moving along. The old business first order is the status of the FOI request. I did receive a response, an email response from Chairman Anthony Favry, which I, with a lot of self-control, which I don't always have, did not respond to, because he mentioned in there that these, basically these are difficult times and we're working on it, but we've got other more important things, to which my response would have been, well, you didn't have these other things 2 years ago when we started this. So I got it off my chest saying that to you instead of to anyone else. So, but they're working on it. The wheels are turning. My problem with that is, of course, my preferred solution would be just either call Omni or have an Omni representative come to our meeting. We'll ask the questions and we'll get the information we need. I'm concerned now that the staff at the central office is putting something together. We don't know what it's going to be. And then if we get it and it's not what we want, then we look like we're just difficult to please people. So that's the status right now. Is I'm waiting, and they should be providing some information to us. I've given them samples of the type of information we're looking for. The town publishes the figures that Don just told us and that Don puts out. Here's the number of people in the different plans. And then I sent them, just so they don't think that somehow this is confidential information, I sent them the annual report that I and others get from General Dynamics, which lists how many people are in each plan, how much money's in each plan, and all of those type of things. So it is a requirement by the government that, organizations notify their people on the status of their plans. So that's where we are. Nothing much to report there until I hear more.
Hey, John.
Yes.
Hey, John. This is
Go ahead.
Dan. I think your comment about Omni is a good one. If we could save everybody maybe a lot of time and effort if Omni was just willing to come to one of our meetings. I mean, in light of what the gentleman's telling you, that they got a lot going on right now with COVID, which is understandable, did you suggest to him, hey, well, maybe we can take a little off your plate. Why don't you just put Omni in contact with us and we can just talk to them directly?
That is an excellent statement, and I think that's a great reply. Thank you. I think that's a great reply to send to Anthony. That would be great.
I mean that in a respectful way. I can imagine they got a lot of stuff going on right now. We understand, but let's take this off your plate. Just put me in contact with Omni, and we'll talk to them, and we'll let you know when they're coming to our meeting. You're welcome to sit in on it too, but that's one less thing now you have to worry about.
That's an excellent point. And that's the reason why I asked for the Omni contract, because I want to see what exactly they're paying Omni to do. Now they can argue that that Omni is just acting as a pass-through, but that would be silly to hire a company to just take funds and just divvy them up. But maybe that's it. And if that's the case, then really there's no one who's acting as their fiduciary. So that's what I asked for. But again, Dan, I wanted to see the contract first, because if we bring Omni in and they give us, the Italian salute saying, well, I don't know any of these things. That's not what we're paid to do. We're just paid to put money into different buckets. The Board of Ed sends a check to Omni, and Omni goes and, acts as the middleman to just deposit the money. So I wanted to see that first. Let me see if I get that, and then of course the point is there a contract with Omni? So, but anyway, good point, Dan. And that's the perfect response that I can give. Thank you. And that was in the letter, Dan. Hey, please.
Oh, okay.
I think it was in the letter where I said, hey, a meeting with Omni would have resolved this, something like that. Yeah.
Right. Okay. Thanks.
Okay. Let's see. Moving on, the status of the ordinance. Please, I've gotten comments from Dan and from Bill, and of course, Don and I and Marcia have been going around on this. I think we've certainly beat this thing up quite a bit. Interesting point that the revised ordinance has the words, what's the word now? I can't think of it, not optional, but it talks about, and it specifies that the pension board is also responsible for elective plans, which would clear it up. Now, before it said, it certainly, if you read it, it says it encompasses all plans. So the issue that Don brought up is certainly covered in the ordinance, because it talks about general government and Board of Ed employees under the DC plan. But again, hopefully the council is up and running. The next step right now, really, it's gotten through finance, it's gotten through the admin committee. They may need to vote on it the next time they meet, and that would probably be their first meeting in June. After that, the council would set a public hearing. So I'm hoping, if things open up again, that we can get this ordinance approved in July. But again, if you see anything, just let us know, okay? Any comments on that? Okay, moving on to new business. We had Chris's presentation. Is it okay with everyone if we put that on for old business to authorize Chris, or what's your pleasure on the realigning of the 401A. I know we need to talk about the fees, but as far as the realignment of the plan, what's your pleasure?
This is Bill Thorne. Can we table that and discuss that next meeting? And one of my questions was, I guess I probably should have asked, well, it's really not a Chris question. I mean, is it going to cause any issues? I mean, he said the plan is, he likes the way it is now. He likes the fee structure. Weigh that against what might, what agitation it might create by going and making these changes. Is it worth it, I guess, is the question I sort of come down to.
Well, one of the things is this new policy statement that Chris gave us probably addresses these types of things. The problem is we don't have a plan. We don't have that document right now in force. But Don, how do you see that?
I'm sorry, I muted myself again. So just to remember when we did, again, harkening back to last year when they changed the fee structure, we had to send out a letter from here indicating to each of the participants that the fees were going to be split and the town would continue to pay the base 0.25 and the additional fees would be paid out of their accounts, not one peep from anybody. So I don't expect there would be any issues with the people who are in the plan.
Yeah, and I would think the communication would emphasize it's really being done for their benefit because it is.
Yes.
It makes it simpler, and there's even the potential there that depending on their particular investment option, that there's a reduction in the fees.
And if you look at it, some of those funds have no investment.
Right.
So,
like the real estate investment, taking it away, it shouldn't impact anybody.
yeah, I'm just looking at it now, and there's several that have. There's at least two of the three that we're eliminating have no money in them. So, I'd be amenable to authorizing. Well, how do we need to do this? Someone needs to get the ball rolling here.
This is Bill again. How about if we get the investment policy statement signed and in place?
Okay, I'm good with that.
Before we make the move.
Okay. So we'll take it up at the next meeting. We'll take up the policy statement and the issue of the funds. Okay, good. Okay, Mary Beth. So we'll put that on our agenda. Okay. Let's see. I lost my thing here. Okay. Next order of business here. Okay. Sorry. I'm in the minutes. Okay. Next, I will make a motion, move that to approve the FIA invoice in the amount of $5,000 dated March 31st, 2020 for the town's 401A plan diagnostic review. Okay, we have a motion, a second, and that is the cost of the study that Chris just presented. Okay, any discussion? All in favor?
This is,
Was there a comment there?
yeah, I have a comment. Again,
Oh, okay. All right, go ahead.
This could be showing my ignorance, but so this 401 has, this is the town's, we're taking the money out of the town's part of the contribution, but it's really a matching contribution. That's the question I have is how can we just pull, how can we just pull $5,000 out of that when what's in there is really a match? Sorry.
Okay, Marcia.
I can jump on that. We budget an amount for the matching money. And so there may be some left over in that. We also have the forfeiture account, as we mentioned earlier, people who leave early. So the forfeiture account currently has about $20,000 just sitting in it at Voya that we can do with what we want. So if we need to dip into that, we can take the $5,000 out of that also. So that's money that the town has spent that the employees weren't able to take when they left. So it's the town money.
Okay, and Don, is that you hear that defined contribution plan? So that's a sub fund within that. That is an account number.
Sorry, I had a hard time hearing.
No, you list an account there that where we're gonna take this money.
That's our operating budget. That's the line where I budget for how much I project we're going to have to match for the next year. So that's always a little, padded up a little bit because you don't know how many new employees are going to get hired, et cetera. And so so it could come out of that fund. But as I said, there's also 20,000 available in the forfeiture fund if we wanted to pull some of that out and use it to pay the invoice.
Okay, so the forfeiture fund is a standing fund. That's money
in the VOIA account. Yes, it shows as a separate account as if it was a person with a balance of 20 and change in there.
Okay, would that make more sense? Bill?
He answered my question. Now I understand. I just didn't realize it was money that didn't belong to anybody set aside.
Right. It's not going to impact any of the employees. That's the answer. Short answer to your question.
Okay, excellent. Any other questions? All in favor?
Aye.
Aye.
Opposed? Okay, motion carries. Okay, next, I move to approve the Segal invoice dated April 30th in the amount of $1,600 for actuarial and consulting services. Do I hear a second?
Second.
Okay, all right. Any discussion or questions? Okay, all in favor?
Aye.
Opposed? Okay. Next, I move to approve Segal invoice dated April 30th, 2020 in the amount of $400 for benefit calculations for Amico.
Second.
Okay, any questions or discussions? Don?
Hey, John, did that number go up? Didn't that used to be 380?
That's correct. It appears they raised it, but this was the first bill that came in at 400. I'm sorry, I did not follow up on it, but I will, just to be sure.
Yeah, because it would seem like if they're raising the rates, they should have notified us that.
Okay. All in favor? Aye.
Aye.
Okay. Am I looking at the correct, is that the last item on the agenda, Don?
Yes, it is.
It is? Okay, I thought we had it. Okay. All right. Any other business to come before us?
Just really quick, John, Executive Order 7 double P extended the prohibition of meetings of 5 or more through June 20th.
Okay.
So this may be business as usual again for June, just so you know.
Okay. All right. Very good. Well, I thank you very much. And I mean, this is very comfortable and convenient for most of us, but we do miss seeing all of your bright faces, at least. Okay. All right. Well, everyone be safe. Have a great Memorial Day weekend, and we'll see you next month, if not sooner. Thank you all.
Thanks. Aye.
Motion? Sharon, okay.
Yes.
Do I hear a second? I'll second that. Okay, all in favor? Aye, we are adjourned. Okay, thank you all.
Have to vote on adjourning.